Welcome everyone to our Pellegrini Financial fourth quarter video market update call. Kind of a wrap, of course, of 2023 as we've moved into 2024 now. And, it was a decent market, I guess, to say as a whole for 2023. And really it was, best way to explain it, I suppose, the book ended between for returns. We started the year off well in the month of January with a good return. We had much of a sideways market as we went through much of 2023, as we kind of talked about in past calls, of course. And in Q3, where we started to see markets pull back a little bit in the September and October. And October, of course, is where we start Q4, and that was a negative month. And that was some negativity that carried on from like I said, September, and worry about corporate earnings and ongoing inflation and stuff like that. As we got into Q4, we saw inflation become a little bit more under control, I guess. So inflation concerns kind of went by the wayside to some extent. And at the same time, we also saw kind of the first inklings of interest rates dropping. And that, of course, is very positive for markets, more so on the fixed income and the bond space in particular. And so markets really took off in the month of November and carried on through the month of December as well. So those positive returns at the start of the year and the very end of the year were really what made up the market returns for 2023. And there was a positive, like a solid double digit returns for the year, which was nice. And so certainly a good way to recover off the 2022 year. And so, as we went through the fourth quarter here, there's certain components, I suppose, that performed exceptionally well. Obviously, in the Canadian market, place in particular was information technology, and that is replicated, of course, in the global markets. But info technology was the strongest performer on a year-to-date basis in Canada. Other sectors like energy were relatively flat at a 1%. And we saw some of the negative ones were really the services and the utilities market in Canada. When we look at more of the global equities in particular, again, NASDAQ, the tech heavy NASDAQ in the US, certainly led the way in the quarter for Q4, but also a year to date basis. The S&P 500, of course, the broad US market was a strong performer throughout the year. And when we look at some of the global equities, in Asia in particular, of course, we kind of had diametrically opposed markets from the Japanese Nikkei, which was up strong for a year to date basis, and the Chinese market that was negative both in the quarter and on a year to date basis, as economic concerns were driving stocks lower in China in particular. As a whole, Europe, of course, did quite well. Canada was lagging. Most of those other economies, generally speaking. But again, finished the year on a quarterly basis quite strong, and on a year to date basis as well. A lot of the tech stocks, of course, were led by a lot of the Magnificent Seven, as they call them, and some of it tied into artificial technology or artificial intelligence, as they talk about. We'll get a bit more into that here in a bit. When we look at interest rates in particular, again, obviously we've gone through this quite extensively through the year, but obviously the one graph there on the left hand side that shows a lot of all the federal central banks, so whether the U.S. Federal Reserve, the Bank of Canada, the Bank of England, and the European Union, and they're all pretty much lock in step in many ways in regards to how they rose rates through the last year and a half, 2 years, and so they have all ended up, more or less around that 5% mark as a central bank rate. Obviously, that was a steep rise, probably not seen much before in the past. That, of course, was intended to combat inflation. So the other chart there is showing the Canadian inflation rates, which, generally speaking, were trending down or coming down through this past year. Again, a little bit of uptick as of late. And so that inflation battle certainly hasn't been won necessarily. But certainly the bigger concerns of inflation running out of control have gone by the wayside. And so they're, like that, like always, that last mile is the toughest. And so I think, there's still some concerns about inflation, where it's headed or where it's at. Obviously, getting down to the 2% level is still going to be a bit of a battle. But certainly, the expectation of seeing any more interest rate hikes is not very likely. Obviously, there's talk of more inflation or interest rate cuts here going forward in the next year. Again, that is going to be dependent on obviously inflation, but also economic factors and whether or not that we get into recessionary territories or not is still to be determined. And so as we look at that and some of the economic GDP numbers here coming out, uh, the top chart here is specific to Canada. And of course, we had negative growth here in Q3. Q4 is expected to be positive, 0.7% up on the positive side. Those numbers aren't finalized till the end of February here, but that's the expectation at this point. So, not a technical recession, of course, which is good so far. Um, are there still expectations of recession in 2024? Yes, there's probably more in the yes camp than the no camp. Certainly, our growth in Canada, in particular, of course, is quite anemic to begin with. So even if it isn't negative growth, it certainly feels like it in many ways. Uh, the bottom chart there is the Chinese economic growth, and that's looking at over the last 25 years. And I put that in there because China does have an influence on global economies, global markets. And that growth really has been declining now. You could say maybe peaked in about 2007 or 8 in China, and of course, it's been declining ever since. The COVID thing kind of skews things a little bit in that chart, but the trend line is there. So, economic growth in China has always been steadily declining for the last number of years. They are, again, where maybe was talked about where they would overtake the USA in regards to the economic size and be the number one in the world. That's probably not happening. And of course, demographics is not on the Chinese side either, right? It's an aging population, and you just don't get that growth, of course, with an aging population. India, of course, is the up and comer that everyone still looks to as the opportunity. A young population, a large population, educated, free economy, and it's not a new story by any means. I think there's hopeful growth in India, and I guess the opportunity there for them to overtake China as in economic size, and maybe eventually the USA in economic size. I think the biggest thing is for themselves to get out of their own way in the way their economy functions and operates, whether it's the black market or just corruption in general. Um, those are the things that always seems to inhibit Indian growth. But the opportunities are still there, and that's where markets are certainly looking towards. When we look at some of the commodities, I guess in particular, and I kind of focused a bit more on oil this time around. Obviously, it's important to us in Alberta, it's important to Canadian markets in general. Oil, of course, through the last quarter here really pulled back from where it was towards the $90 mark, and that's that top chart here, and settled around in the mid 70s. Oil demand isn't necessarily all that robust at the moment, and production, of course, has been phenomenal, especially in North America. So the USA and Canada both reached peak production levels, all-time highs. I shouldn't say peak necessarily, but all-time highs, and so that obviously weighs into the oil market pricing, even though OPEC continues to cut production. There's a lot of other players in the world today that, and of course, North America actually produces more than the Middle East, at least at the moment. And so, OPEC cuts certainly has an influence, but they don't have the same influence, obviously, as they did before. The bottom chart is actually a chart that just shows the U.S. oil rig utilization. And so we've seen the number of rigs out there decline, obviously, over the last 10 years, but it's more important. I'm kind of looking more at the last year or two in particular, and even into 2024 now. And like I said, 2023 as a whole was a declining rig count all the way through. um, there just isn't the spending. The big oil players and the majors of the marketplace just we've seen capex numbers just be capped or reduced. There is not the investment at the moment into drilling and replacing existing production. Time will tell where that goes, but obviously the expectation is that that should influence oil prices to move higher as time goes by. But it is just an interesting chart because it's been a pretty big decline in the U.S. rig count over the last number of years, and like I said, even in the last particular year as well. When we go on to where things are and going forward, I think 2024. I suppose the biggest positives right now are the fixed income space and bonds in particular, and certainly we've talked about that in different meetings with yourselves. And but that I think remains to be the case for 2024 as a whole. Rates probably have peaked. Not likely any interest rate hikes are to come down the road. And obviously, the discussion is more so maybe perhaps some rate cuts later in 2024. Well, both of those are positive for the fixed income space. So, one, again, we've seen rates ratchet up much higher very quickly. You're the benefactor, you're the beneficiary of those higher interest rates, right? In the bond yields and the bond fixed income space, you're the benefactor of that. As rates come down, and the expectation is they will somewhere along the line, whether it's later in 2024 or 2025, um, that obviously gives you extra tailwind in bond pricing because prices will go up. And so that's a good momentum in a portfolio to have that bond and fixed income component. The equities, maybe are a little softer. You can say there's opportunities in Chinese markets or the oil market in particular. But equity markets, perhaps at the moment, are fair valued, if not maybe a bit stretched in some areas. That's probably factoring in expectations of slower economic growth, risk of recession, those kind of things. That doesn't make the equity markets as enticing. It's not like it's a bad space, though. There's opportunities there, but certainly the fixed income probably outweighs that at the moment. Energy markets themselves, again, with the lack of spending, you expect that the price of oil is should be a benefactor of that. It would be interesting as just a side note to see as our pipeline capacity increases, Trans Mountain in particular, if it finishes up completion here in Q1, how much of a discount rate is reduced. Western Canada Select, of course, is discounted quite significantly to WTI. Um, and that's lack of again space to get our oil to markets. So it'd be interesting just to watch that as a side note. Technology, of course, will continue to play a role in everyday lives for everyone, and again, the artificial intelligence discussion is a big part of what moved technology stocks last year. And you see that AI technology, particularly in the healthcare sector, and healthcare I think is still a big another component that probably has a lot of positive light to it in 2024. AI itself is talked of in different ways, but it certainly plays a big role in healthcare, and I think that's part of where technology lies going forward as well. So right now I think there's a lot of positive shoots in 2024, especially again in the fixed income space, and so we'll see how that plays out here in the coming months. Anyways, I'd like to thank you for joining us here in a wrap to 2023 and looking forward to what 2024 brings us. Take care and bye for now.